Okay, so for week 5, we have a very, very meaty topic, but there's not a lot of slides. So we're about at half the amount of slides that we would normally have. So for week 5, our only topic is going to be accounting for income taxes. And what we are going to talk about specifically for this week is the difference between pre-tax financial income and taxable income. And then we're going to talk about temporary tax differences, which are often referred to as DTAs, deferred tax assets, and DTLs, deferred tax liabilities. We're then going to continue our discussion by talking about permanent differences and what happens when a company has a net operating loss. And then we'll finish up the lecture with a discussion over the financial statement presentation for taxes. So up until this point in the course, our focus has really been on reporting net income for investors or for creditors, as well as, for the FASB and for the SEC. However, IRS accounting guidelines are not the same as US GAAP. And therefore, pre-tax financial income, which is a measure that we see on the income statement, is not the same as taxable income, which is the term that's used by the IRS and what is your taxes are based off of. So pre-tax financial income is a financial reporting term, also called income before taxes, income for financial reporting purposes, or income for book purposes. And pre-tax financial income is derived by looking at US GAAP. Now, on the other hand, taxable income is the tax accounting term which represents the amount used to compute income taxes payable determined using the IRS tax code. So if we take a look at an example of Bubblegum Blues Company, for US GAAP reporting purposes, for a 3-year period, they have revenues of $130,000. And in each of those 3 years, they also incur expenses of $60,000, which gives them pre-tax financial income of $70,000 a year. Their tax rate is 40%, and so their income tax expense is $28,000 a year for 3 years. So at the end of the 3 years, they end up having a 3-year cumulative pre-tax financial income amount of $210,000 and income tax expense of $84,000. Now, for tax reporting purposes, I want you to keep in mind that in general, and this is a generalization, so it doesn't always apply, but in general, tax reporting is much more based on cash basis accounting. And part of the reason for that is the taxing authorities feel like you can't be taxed on your income until you've actually received the cash, because otherwise you would not have the wherewithal to pay the taxes. So, whereas in US GAAP reporting, right, revenue is recognized based upon the 5-step process that we talked about in week 3. Oftentimes for tax reporting, revenue is recognized when the cash is actually received. So what you'll notice here is that in 2012, we only recorded $100,000 of revenue. But in 2013, we recorded a little bit more, and in 2014, we recorded a little bit more. In this example, our expenses were $60,000 a year. So what you'll notice is that our taxable income was $40,000 in the first year, $90,000 in the second year, and $80,000 in the third year. Now, on a cumulative basis, that taxable income over those 3 years was $210,000, which matches the US GAAP reporting. So over time, the amounts are equal. It's just the timing of when those amounts are recorded. So what you'll notice then is that income tax payable, which is the tax reporting term was $16,000 in the first year, $36,000 in the second year, and $32,000 in the third year. So, again, over the 3-year time period, $84,000. So what we basically have going on here then is we have timing differences, which are going to give rise then to deferred taxes. So, future taxable amounts and deferred taxes. So, temporary differences result when the tax basis of an asset or a liability and its reported or its carrying or financial book value are different. This difference will result in taxable amounts or deductible amounts in future years. So, let's go back and look at our example from before. So, we know that in 2012, Bubblegum Blues Company recorded revenue of $130,000. And let's pretend that of that $130,000, that $100,000 of that was cash, and $30,000 of that was AR. Okay? Now, tax reporting purposes says you can only record revenue when cash is received, so therefore their revenue was $100,000, and they're basically saying for tax basis you didn't have an AR balance because we don't record revenue until the cash is collected. So as a result then, there's a difference between the book basis and the tax basis of $30,000. So that is the difference, and then, so that's the difference in basis, and then what we need to do is we need to tax effect that at the tax rate, which is 40%, to get to $12,000. So that $12,000 represents a deferred tax liability. So let's first talk about what does a deferred tax liability mean. A deferred tax liability means that our pre-tax financial income is greater than our taxable income. And it is the deferred tax consequences that are attributable to a taxable temporary difference. Now, it's called a deferred tax liability because it represents an increase in taxes payable in future years as a result of a taxable temporary difference existing at the end of the current year. Boy, that was a lot of words. Let's go back a couple of slides and look at what this means in terms of a journal entry. Okay, so now here we're comparing our US GAAP reporting to our tax report. So if we look at what our journal entry is going to be, we are going to debit income tax expense for $28,000. We are also then going to credit income taxes payable for $16,000. Now, the difference between those is $12,000, and that $12,000 is exactly this deferred tax liability amount that we just calculated on the previous slide. So, our journal entry then is going to be debit income tax expense $28,000, credit income tax payable $16,000, credit deferred income taxes, or it can be deferred income taxes, or deferred tax liability is a better terminology to use, for $12,000. again, what this means is that we've taken an expense on the P&L and we have a future obligation to basically pay for that in our tax return, but we're not going to pay for it on our tax return until a later year. It's deferred, and that's therefore also why we're creating a liability, because it's an amount that we owe to the IRS, but we just don't owe it yet because it hasn't become due yet from a tax reporting perspective. When a deferred tax liability is most often created is when we recognize revenue for U.S. GAAP purposes that has been deferred for tax purposes, which was exactly the example that we just went through, where we had $130,000 of revenue for GAAP purposes, but only $100,000 for tax purposes, because for some reason the triggering event to recognize revenue for tax purposes hasn't happened yet. So that's the most often example that you're going to see on the revenue side. On the expense side, it's often caused when we defer expense recognition for U.S. GAAP purposes that has been recognized for tax purposes. So we often see this when we pay for a multi-year service contract up front. Because again, remember that U.S. GAAP, right, is based on accrual basis accounting, so we're going to expense that multi-year service contract over time, whereas generally speaking for tax purposes, it's when the cash is paid. So you get to take that entire multi-year service contract as a deduction in the year that you paid for it. And so in this situation, right, we have more expenses for tax purposes than we do for U.S. GAAP purposes. Therefore, our pre-tax financial income is greater than our taxable income. Okay, so income tax expense, so the debit to income tax expense has two components. There's the current tax expense and the deferred tax expense. So current tax expense is the amount of income taxes payable for the period. Again, if we go back to the example we just looked at, that amount of income taxes payable for the period was the $16,000. The deferred tax expense is the increase in the deferred tax liability balance from the beginning to the end of the accounting period. Okay, so let's pretend that this company had just been created, so there was no beginning deferred tax liability balance, and then at the end of the accounting period, the difference in basis was $30,000. The tax affected amount then is $30,000 times 40% or $12,000. Okay, so you can see our journal entry right there. Okay, so now let's take a look at the next year. So in 2013, we had revenue again of $130,000 for U.S. GAAP, and for tax reporting purposes, we had $150,000. Okay, so what basically then happened was we need to look at the difference between our book basis and our tax basis. Now, these are so we're going to take the $130,000, that was our 2012 amount, we're going to add to it our 2013 amount of $130,000, so cumulative now, we had $260,000 of revenue for U.S. GAAP purposes. For tax purposes, we had $100,000 in the first year and $150,000 in the second year, so that's $250,000. So now our difference in basis is $10,000. Okay, so our difference in basis is $10,000. We need to tax affect that at 40%, which means that now our deferred tax liability is $4,000. So the deferred tax liability of $4,000, that's the end of period balance. So my deferred tax liability at 12/31/2013 is $4,000. My deferred tax liability at 12/31 of 2012 was $12,000. So now it's gone down by $8,000. Okay, it's decreased, which means that some of my deferred tax liability has become payable to the IRS in the current year. So now let's take a look at what my journal entries would look like. Okay, so my journal entry, my income tax expense. Okay, my income tax expense is my US GAAP amount. So that is my $70,000 of pre-tax financial income at 40%. That's my $28,000. Okay. My income tax payable amount is my $90,000 of taxable income at 40%, which is $36,000. Okay. And we know that my deferred tax liability balance went down by $8,000, so that's a debit to deferred tax liability. Okay, so what again this means here is I owe more money to the IRS because my income tax payable is $36,000. However, a portion of that I owe the IRS I had previously recognized as expense in my financial statements. In fact, I had recognized it as expense in 2012. Okay, so now that we have kind of a basis for how this works, let's take a look at what the objectives of income tax accounting are. So number one is to recognize the amount of taxes payable or refundable for the current year. And the second is to recognize deferred tax liabilities or deferred tax assets for future tax consequences of events that are already recognized in the financial statements or the tax returns. So now let's look at another type of example. So in this situation, we have a future deductible amount. So before, we were looking at a future taxable amount, but now we're looking at a future deductible amount. So in 2012, Crown Royale Inc. accrues a loss and a related liability of $50,000 in 2012 for financial reporting purposes because of pending litigation. So for book purposes, for US GAAP purposes, right, we have basically debited litigation expense for $50,000 and credited litigation liability. Okay. So as a result of recording this entry, right, our net income is now lower because we have this $50,000 of litigation expense. For tax purposes, however, the litigation expense is not allowed to be deducted until it's paid, which happens in 2013. So, if we take a look then at the difference in basis of litigation liability, we know that the book basis of litigation liability is $50,000. We have that $50,000 balance sitting on our balance sheet. From a tax perspective, no balance exists because we didn't get to deduct it for tax purposes. So therefore, we have a $50,000 difference. At 40%, we have a $20,000 deferred tax amount. Okay? And in fact, this $20,000 deferred tax amount is a deferred tax asset. What is a deferred tax asset, you might ask? Well, a deferred tax asset occurs when our taxable income is greater than our pre-tax financial income. And it is the tax consequences that are attributable to a deductible temporary difference. So what this means is there's going to be an increase in taxes refundable or saved in future years as a result of the deductible temporary difference existing at the end of the current year. So, let's take a look at the journal entries for this. Okay, so let's first assume that book income was $200,000. Okay, so therefore, income tax expense would be the $200,000 at 40% or $80,000. Okay, so our journal entry then is going to be a debit to income tax expense of $80,000. Okay, for income taxes payable, we know that that book income of $200,000 includes a $50,000 expense for the litigation. Therefore, assuming no other differences, that means that taxable income would have been $250,000. So $250,000 at 40% is $100,000. So credit to income taxes payable of $100,000. Now, the difference between those two amounts is $20,000, which is our deferred tax asset, which is also calculated 2 slides ago when we took the difference in basis of $50,000 at 40% gave us $20,000. So, what do we have here? So basically what's happening is we have income taxes payable of $100,000. Of this $100,000, $80,000 of it represents amounts that are due today related to today's operations, and the remaining $20,000 represents a temporary difference that is going to be deducted on a future tax return. And therefore, because it will get deducted on a future tax return, okay, in the future, our taxable income will be lower, and therefore, as a result of having a lower taxable amount in the future, we are going to record a deferred tax asset today. Okay, then let's look at what 2013 looks like. So, in 2013, our book pre-tax income is $400,000. Again, we're assuming no other differences. In a couple of slides ago, it said that we paid for that litigation settlement in 2013. Therefore, our taxable income is lower now. So, our deferred tax asset amount at the end of 2013 is going to be 0. At the end of 12, it was $20,000. So we have $20,000 then in the current year that is deferred tax expense. So our journal entry then is going to be income tax expense of $160, income taxes payable of $140, and we're reducing that deferred tax asset of $20,000. Okay, and at this point now, our deferred tax asset is 0, and it makes sense that it would be 0 because at this point, the temporary difference is gone. Okay, now when it comes to deferred tax assets, we always need to think of something called the valuation allowance. This needs to be thought of for any deductible temporary differences. So, a company has to reduce their deferred tax asset by a valuation allowance if it is more likely than not that it will not realize some or all of the DTA. More likely than not typically means that there is more than a 50% chance. And when we think of the valuation allowance, we need to think about it in terms of similar to the allowance for doubtful accounts for AR. Okay, and so what this is really asking us to consider is whether or not we are going to be able to enjoy the fact that that a situation will arise in the future where we actually will get to deduct this for tax purposes. And we'll talk in a few minutes about some situations that might arise that may not allow us to deduct it in the future. Okay, so valuation allowance example. So Smith Company has a deductible temporary difference of $1 million at the end of 2015. Its tax rate is 40%. So a deductible temporary difference gives rise to DTAs. Therefore, Smith is going to record a DTA of $400,000. After a careful review of all available evidence, Smith Co. determines that it is more likely than not that $100,000 of that deferred tax asset will not be realized. The reduction is recorded as follows. So we're going to increase our income tax expense by $100,000, and we are going to credit valuation allowance DTA for $100,000. Okay? So what we're basically saying is, okay, we were able to deduct something, or something happened that resulted in an expense on the income statement for US GAAP purposes, but we're not going to get that same amount of deduction for tax purposes. Perhaps because it's not deductible, perhaps because it's only partially deductible, or our future tax situation is such that we aren't going to be able to reap those benefits. And we'll see that a little bit with net operating losses. Okay, so how do we compute then income tax expense? So we've basically already been through this. So your income tax is payable or refundable depending on the situation that you're in, plus or minus your changes in deferred income taxes equal your total income tax expense or benefit. When it comes to your income statement presentation, you must include both the current and deferred portions of income taxes, either on the face of the income statement or within the notes to the financial statements. And I will tell you that most companies will do this in the notes to their financial statements. So this is just an example of Hormel. Okay, so we've already talked about temporary differences, but what I want to kind of do now is summarize them, because kind of bring the topics together, and then go through some other examples of the different types of temporary differences. So when it comes to temporary differences, there are two types. The first is a taxable temporary difference. And a taxable temporary difference is a temporary difference where our pre-tax financial income is greater than our taxable income. And as a result, we will have higher taxable amounts in future years when the related assets are recovered. Okay? So the best example we've already been through is accounts receivable, right? Is that for US GAAP, right, you recognize revenue when it's earned. For tax purposes, you recognize it when you receive the cash. So when we think about the related asset, that related asset is accounts receivable. So taxable temporary differences give rise to deferred tax liabilities. On the other hand, deductible temporary differences are when your taxable income is greater than your pre-tax financial income. These will result in deductible amounts in future years when the related book liabilities are settled. These give rise to deferred tax assets. So some examples of deferred tax liabilities. specifically when revenues or gains are taxable after they are recognized in financial income. So again, remember that deferred tax liabilities are when pre-tax financial income is greater than taxable income, which typically means one of the scenarios that this can happen is when we get to record revenue or gains for financial purposes that we don't get to record for tax purposes yet. So I'm not going to go through these, but here are some specific examples of why that might happen. Now, for deferred tax assets, we know that this is when taxable income is greater than pre-tax financial income. And this can sometimes happen when expenses or losses are allowed to be deducted for financial reporting purposes, but not for tax purposes. So again, you can go through those examples, and those give rise to deferred tax assets. Now, there are a few situations where taxable income is going to be greater than pre-tax financial income, and the cause of that is on the revenue or the gain side. And so revenues or gains that are taxable before they are recognized in financial income, most of the time is going to happen when cash is received up front for something. And then finally, there are a few situations where expenses or losses are going to be deductible before they are recognized in financial income. So again, a DTL is going to be created when your pre-tax financial income is greater than your taxable income. And the most often cause of that is when you get to take an accelerated form of depreciation for tax purposes. Okay, so far right now, all we have talked about are temporary differences, meaning that those temporary differences are going to resolve themselves in the next year or 2 years down the line. There can be any number of years that it takes for that difference to turn around. Now, there are going to be some differences which never turn around, and those differences are called permanent differences. And permanent differences result when there are differences between taxable income and pre-tax financial income. And situations like that may be that they enter into pre-tax financial income but never into taxable income, or they enter into taxable income but never into pre-tax financial income. And oftentimes these result from tax law provisions that have been enacted for certain political, economic, or social objectives, which may exclude certain revenues from taxation, that limit deductibility of certain expenses, or permit the deduction of certain expenses in excess of costs incurred. So things like that may be tax-exempt interest. There are non-deductible expenses such as fines and bribes, the dividends received deduction, etc. Now, when it comes to homework problems or to your quizzes, you are not going to necessarily be expected to know, oh, this is a permanent difference. I will tell you sort of the US GAAP and the tax-related treatment, and then you'll be able to solve a problem from that. So I'm not expecting you to know the tax treatment for certain items, but I do want you to be able to apply the differences once you're told what they are. Okay, so here we're going to look at an example that has both a temporary and a permanent difference. Pop Chips reports pre-tax financial income of $200,000 in 2014, 2015, and 2016, and is subject to a 30% tax rate. Pop Chips reported an installment sale of $18,000 in 2014 for tax purposes over an 18-month period, with the first installment recorded in January 2015. It recognizes the entire sale for book purposes in 2014. Pop Chips pays life insurance premiums for its key officers of $5,000 in 2015 and 2016. Although not tax deductible, Pop Chips expenses the premiums for book purposes. So, what we need to then understand here is that the installment sale is a temporary difference, and the life insurance premiums are a permanent difference. Next, I want to take a couple of minutes to go over some tax rate considerations. So, permanent differences give rise to the fact that the effective tax rate may not equal the statutory or the regular tax rate. So, our effective tax rate is calculated by taking your total income tax expense and dividing it by your pre-tax financial income. Your statutory or regular tax rate is your normal tax rate. So in the problems that we've been going through, I've said that that's 40%. So what happens though if tax rates are expecting to change in the future? Now, regardless of what legislation is pending or what the president or the White House or the government is talking about, companies use the current tax rate unless a different tax rate for future years has been enacted, aka legislation has been passed. When a change in the tax rate is enacted, companies should record its effect on the existing deferred income tax accounts immediately by reporting the effect as an adjustment to income tax in the period of change. So, if you think about the previous slides that we've talked about, when we created our deferred tax assets and our deferred tax liabilities, those were created at the statutory rates, 40%. But if all of a sudden a new tax rate is enacted, we need to revalue all of those deferred tax asset and tax liability accounts. Now you may recall at the end of 2017, President Trump enacted sweeping tax legislation, and one of the provisions of that was to reduce the corporate tax rate. Well, his timing was not great for some companies, in fact for most companies, because he enacted that legislation in mid-December, and most companies were coming up with their to the end of their calendar year, and therefore they had a lot of work that they had to do in order to book adjustments to their deferred tax assets and their deferred tax liabilities for year-end reporting. Next, I want to spend a couple of minutes talking about net operating losses, which you often may be heard as NOLs. So, a net operating loss occurs, this is a tax reporting term, in a year when tax-deductible expenses exceed taxable revenue. And so, what the government has said is that it would be inequitable if companies were taxed during profitable periods without receiving any tax relief during a period of net operating losses. So what taxpayers then are allowed to do is to use the losses of one year to offset the profits of other years via the carryback election, or they can elect to carry forward those net operating losses to the future. So, the rules for carryback and carry forward say that a company can carry back their net operating loss 2 years, and receive refunds for income taxes that they've already paid in those years. And if they do elect to do this method, they need to apply the loss to the earlier year first and then to the second year. So let's pretend we're in 2019. Then in 2019, you suffer a net operating loss. You would first go back to 2017 and offset your net operating loss against any profitability in 2017. Then if you still haven't recouped all of your losses, then you would turn to 2018. Now, if looking to both 2017 and 2018, you still have a net operating loss, you can carry forward that loss for 20 years to offset future taxable income. Now, some companies elect to omit the carryback provision and utilize the carry forward option only. So the downside to omitting or to not electing the carryback provision is that you don't get your cash back right away. But by waiting and utilizing the carry forward option, that may be beneficial if you know or you think that the income tax rate is going to be higher in future years because you'll get a bigger benefit. So let's look at an example. So in 2012, Company A experienced a loss of $500,000. We're going to carry back that loss first to 2010 and wipe out the $100,000 of the $500,000 loss and receive a tax refund of $30,000. Now, we couldn't carry back to 2009 because we can only carry back 2 years. Next, we're going to look to 2011 and wipe out the $200,000 of taxable income, and we're going to receive a refund of $80,000. Then, we are going to carry forward the remaining loss of $200,000 to future years. So our journal entry then would be a debit to income tax refund receivable. So the government owes us $110,000. And then we're going to credit benefit due to loss carryback, which is a sub-account under income tax expense. We anticipate that the government is going to pay us within a year, so we are going to classify income tax refund receivable as a current asset. Now, that takes care of part of our entry, but we also need to consider the part of the entry for the amount that we haven't received back yet. So the tax effect of the loss carry forward represents future tax savings, right? We're not going to have to pay those taxes. So because it results in future tax savings, that is a future deductible amount, and therefore that is a deferred tax asset. So our journal entry is going to be debit deferred tax asset for $80,000 and credit benefit due to loss carry forward or income tax expense. Now, because we've created a deferred tax asset, we will also need to evaluate it for evaluation allowance. So here is an example then where if we don't think we're going to be profitable in the next 20 years, we would never be able to benefit from the deferred tax asset. And if we don't think we're going to be able to benefit with having positive taxable income in the next 20 years, it would be appropriate to record evaluation allowance. However, not the case. In 2013, the company returns to profitable operations and has taxable income of $250,000. This is before utilizing any net operating loss carry forward. The tax rate is 40%. So our taxable income prior to our loss carry forward was $250,000. Our carry forward deduction is $200,000. So our taxable income is $50,000. Our tax rate is 40%. So our income taxes payable for 2013 are $20,000. Now, for pre-tax financial income, that is $250,000 at 40%, gives us income tax expense of $100,000. We have a credit to income taxes payable of $20,000 and a credit to deferred tax expense of $80,000. Okay, so finally then, we're going to talk a little bit about presentation. So, financial statement presentation for the balance sheet. We are going to net our deferred tax assets and our deferred tax liabilities together and present them as a net number. We are also going to present our current and our non-current DTAs and DTLs combined as a net non-current number. So, individually, deferred tax assets and deferred tax liabilities are classified as current or non-current based on the classification of the related asset or liability for financial reporting purposes. Okay, so for example, right, if the underlying difference is created by accounts receivable, that is a current asset, therefore the deferred tax asset or liability that's created would also be classified as current. However, in 2016, the FASB issued ASU 2015-7, and that became effective for public entities for annual periods after December 15th, 2016. And the reason for this change was as a result of the FASB's simplification initiative. They basically said that there was little to no useful information that was being added by making companies classify deferred tax assets and liabilities as current versus non-current, but it added a lot of cost and complexity, and so they here was an opportunity that they took to say, let's simplify things, and also by making this change, it now matches what the IFRS rules are. So here's an example with AR, and despite the fact that the DTA of $40,000 has been created and it relates to AR, which would be classified as a current DTA, it's going to be classified as a non-current DTA on the balance sheet in accordance with this new accounting standard. Here's another example. So we've got a bunch of temporary differences. And some of them are related to current and some to non-current balance sheet accounts. But at the end of the day, again, we're all about simplification. So we're going to net the 259 against the 54. That's going to give us 205, and that is going to be a non-current deferred tax liability. So in terms of other disclosure requirements that are required, you have to disclose the total of your deferred tax liabilities and the deferred tax assets, any valuation allowance that you have recorded. You need to describe the net change during the year of the valuation allowance, and you need to generally talk about the types of temporary differences, carry forwards, or carry backs that you have. When it comes to the income statement, you are required to follow the intra-period tax allocation. And this basically says that you need to allocate your income tax expense or benefit, if that's what you have, to continuing operations, discontinued operations, extraordinary items, and prior period adjustments. Now, if you recall from Accounting 310, when it comes to how you outline or lay out your income statement, you remember that discontinued operations, extraordinary items were always presented net of tax. So this is where that comes into play. But you also know that the FASB eliminated the extraordinary item classification. So really what we're looking at is, separating out your taxes associated with your discontinued operations from those of your continuing operations. You need to disclose your current tax expense or benefit. You also need to disclose your deferred tax expense. And in general, income tax disclosures are required for several reasons. They assess the quality of your earnings, they help make better predictions about future cash flows, and they also help to understand what might happen with cash flows specifically related to net operating loss carryforwards if you happen to have any of those. And then finally, I just want to spend a minute talking a little bit about uncertain tax positions. So an uncertain tax position is a tax position for which the taxing authority, that is typically the IRS, may disallow a deduction in whole or in part. So just like US GAAP, the tax code can be a little gray at times in terms of what is and is not allowed as a deduction. And as a result, companies might take an aggressive approach in its tax planning in situations where the tax law is unclear or the risk of audit they feel is low. Uncertain tax positions give rise to tax benefits. Typically, this is because a company might engage in some type of tax scheme that, while legal, may or may not actually be deductible for tax purposes. And so, because these uncertain tax positions give rise to tax benefits, these tax benefits should only be realized if a company has a more likely than not chance that these uncertain tax positions will be approved by the taxing authority. And so this is very similar to that kind of valuation allowance, where it's, you've taken a position and now you need to be able to prove that you actually are going to be able to benefit from it in the future. And that is it for week number